Inflation. What does it mean for your money? First, let's start with a basic definition that helps us understand how inflation works. Inflation is a rise in the general level of prices of goods and services in an economy over a period of time. When inflation rises, each unit of currency buys fewer goods and services. Other forms of inflation are stagflation, which is when the economy is stagnant and also experiencing high inflation. Lastly, hyperinflation or deflation is when prices drop so the value of money actually increases. Inflation tends to lead to higher interest rates, which makes investments unprofitable for many businesses and households. You may have heard of the Federal Reserve Bank. The goal of this bank is to keep inflation in check, generally around 2 to 3%, and it does that by raising or lowering interest rates. The reason raising interest rates help control inflation is because it helps to lower and increase demand for borrowing. For example, in a market where interest rates are really low, more people want to purchase, and this helps to balance oversupply and too little demand. As we have seen in the home prices skyrocketing in recent times, when interest was at record lows, more and more people wanted to buy, but it depleted the supply of goods available. The opposite also works. To temper buying and control the balance of supply, interest rates are increased. This makes it so less people want to take out loans for things because they'll be paying more. Because of this, demand falls and then prices eventually follow as well. Inflation decreases the buying power of our money. High inflation can lead to lower savings as people may prefer to spend their money rather than save it. This is especially true if they expect that they will not be able to buy as much with their savings tomorrow as they do today due to rising prices. Having lived through different periods of inflation, it's important to remember that they don't last forever. The other thing to remember is that if you're someone who is saving or investing, continue to do so. Statistically, markets always rebound. The S&P 500 has historically returned about 10%, especially if held through recessions. Too many people become afraid that they will lose everything if markets crash. However, it's more important than ever in bad times to hold on to your investments and savings. Only take them out if you absolutely need to. Inflation can be good or bad depending on how it affects you personally. For example, if you're a lender, inflation can be a bad thing because it means that people who want to borrow will pay you back with dollars worth less than when they borrowed them. On the other hand, if you're a borrower, inflation can be good because your repayments will be worth less than they were when you borrowed them. Inflation has both advantages and disadvantages for consumers. Inflation helps consumers by lowering prices on goods and services over time, as well as increasing wages for workers who receive pay raises tied to inflation increases. Some economists believe that inflation reduces unemployment because people are more likely to take jobs at higher pay rates than they would have previously accepted. As a result, businesses are able to hire new employees without having to increase their prices significantly in order to cover their cost of doing business. The main disadvantage of inflation is that it erodes savings over time. After 20 years, your savings may have lost a portion of its value due to inflation alone. This means that you won't have as much money saved up when you retire or when you need it for other purposes, such as buying a house or going on a vacation. The worst periods of inflation include 1910 through 1920, when inflation was about 15%. The next period was in the 1970s and 80s, when inflation reached 13.5%. Currently, at the time of me making this video, the inflation rate is hovering around 8%. So what do all these numbers mean, and what can we learn from the past? We draw real parallels to the early 1900s because they faced a global pandemic as well. Their world was also experiencing a shift from an agrarian economy to an industrial one. The biggest takeaway would be to remain calm and not buy into the fear. If you have a stable job, continue to save and invest. The worst case scenario we've seen historically is after World War I, when Germany experienced hyperinflation and food prices increased about 139%. This is because they spent so much money on war that their currency was devalued. They ended up printing over 92 quintillion marks, 2 commas more than a trillion. With nothing of value to back their currency and no prospects of a growing economy in the near future, their currency was completely devalued. In the end, remember that inflation is a normal part of the economic cycle and can be caused by many factors, such as economic growth, supply and demand, and currency fluctuations. When you hear all the stories stories about inflation on the news. Don't get caught up in the fear.